Hi, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located here in Oakville, Ontario, Canada. I'm on a mission for hardworking Canadians seeking financial freedom. And today we're going to dive deep into the tax credit versus tax deductions. Typically, when politicians claim that they are putting money back into the Canadians' pockets, that means they are either providing a tax deductions or some tax policies to allow us to claim on our tax return. And this is either done in the form of tax deduction or in the form of tax credit. And do you know any difference between the two of them? And would you prefer one over another? Do you actually know the impact of each tax credit or each tax deduction to you? But before I get started, every week I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. When politicians are claiming that they are putting more money back into the pockets of Canadians, not every policies that they are giving away carries the same tax impact in terms of tax dollar. Some put more money into your pockets, and while some appear to be big, but the impact is extremely small. Real estate investors often confuse tax credit with tax deductions and ask me what's the difference and which one is more beneficial to them. Worse yet, they come to me and ask me why am I not getting a refund when I have such a big write-off. While they both sound very familiar, they provide significant differences in impact. Let's start with tax deduction. Tax deductions are basically the eligible expenses you claim to reduce your taxable income. For example, if you made $100,000 last year and claimed $10,000 in approved deductions, you would only have to pay tax on a reduced taxable income of $90,000. To truly understand the impact of a tax deduction, we need to first get a better understanding of how the Canadian personal tax system works. Canadian tax system on the personal side is a progressive tax system. The more income you earn, the more taxes that you will have to pay. The chart in front of you shows you the marginal tax rates for Canadian residing in Ontario in 2022. So for income range between $0 and $11,000, so the first $11,000, you don't pay any tax. The marginal tax rate on this chunk of income is only 0%. If you earn income between $11,000 to $14,000, the delta between the $11,000 and $14,000, that $3,000 delta is subject to Ontario tax rate of 5%. Now, anything above that $14,000, between $14,000 to $46,000, that is subject, that chunk in between $46,000 minus $14,000, the delta of about $32,000 is subject to 20% tax rate. And so on and so forth. You keep calculating depending on your income level. If you earn a lot more money, then you will have to go through every single tax bracket to come up with the tax rate that's being applicable to the corresponding tax bracket, to come up with the total tax payable. I have simplified the chart in front of you to summarize all major marginal tax rate. However, there are additional income tax ranges and marginal tax rates as well, because the Ontario government has a set of marginal tax rate and tax bracket, and then the federal government also has their own set. And what you see in front of you is the combined set of the two. In our example, we'll assume a real estate investor that earns employment income of $150,000. And to calculate the tax payable for someone earning employment income of $150,000, we have to go through the entire list of marginal tax rate. Here's how it works. Between $0 to $11,000, you get taxed nothing because that is your personal tax exemption, Ontario personal tax exemption. Between the $11,000 and the $14,000 I mentioned, you get taxed at 5.05% Ontario tax rate because $14,000 is the federal personal tax exemption and $11,000 is the Ontario personal tax exemption. So between $11,000 and the $14,000, you would have to pay Ontario tax rate of 5%, but not federal, because for the first $14,000 from the federal government, you pay no federal tax at all. So we take the $14,000 minus $11,000. The delta multiplied by 5% equals $164. Between $14,000 and $46,000, which is the federal personal tax exemption amount and the first upper limit of the first tax bracket, $46,000, you get taxed at 20%. So you take $46,000 minus $14,000, and the delta of it multiplied by 20% equals $6,381, and so on. So you keep going up. You have to go through the above calculation for someone who earns $150,000 employment income, then add them all up in the tax payable column, and we will come up with a total tax payable of $44,642. You can look at the calculation in the chart in front of you. Now we have a better understanding of how our personal income tax system works. We can explain how tax deduction works. Tax deduction is used to reduce your taxable income. For someone who's earning $150,000 in his personal tax return, having an extra $10,000 deduction means that he only pays tax on $140,000. The $10,000 deduction means that he can save $10,000 times the highest marginal tax rate he belongs to, and in this case it is the 43.41%, the highest marginal tax rate that he gets charged on. Now this means that it's equivalent to tax savings of $10,000 multiplied by 43.41%, which is $4,341. So the total tax liability is then reduced to $40,301 instead of $44,642 when he didn't have his tax deduction and he was reporting $150,000 of taxable income. As you can see, a tax deduction is used to shave off the taxable income from the top marginal tax rate. The higher your income, the higher your marginal tax rate would be, and the higher the tax saving an extra tax deduction would give you. Now, what are some of the common tax deductions? First of all, as real estate investors, the biggest tax deductions we get to apply are the ones we discussed in the previous YouTube video, the top 10 tax deductions real estate investors should not miss. Make sure that you watch that video here with the link. We also discussed how you could deduct moving expenses and travel expenses on these two other videos as well. So make sure you take a look at those videos if you want to get a better understanding of how you deduct these expenses. These are all examples of common tax deductions that you can take. Another commonly used one is childcare expense deduction. Rules surrounding childcare expense deduction are a bit more complicated, but similar to all other tax deductions, childcare expenses deduction is deducted against the top marginal tax rate of the lower income spouse, up to a maximum of $8,000 or $5,000 or $0 based on the age of the kids. The younger the child, you would get $8,000 of tax deduction, but for older kids or teenage kids, you may not even be able to claim any tax deductions on childcare expense. As a real estate investor, you're also probably fairly familiar with RSP, Registered Retirement Saving Plans deduction, as one of the best tax saving strategies in Canada. Another commonly used one for investor is interest expense deduction. If you borrow money to invest, the interest expense you incur for the purpose of earning investment income is generally tax deductible as well as a tax deduction. These are common tax deductions that shave the income tax off the top marginal tax rate, giving you the most tax benefits. Now that we've gone through tax deductions, let's talk about tax credit. CLA defines tax credit as an amount that reduces the tax you pay on your taxable income. The more tax credit that apply to you, the more you can reduce your income tax. The federal, provincial, and territorial governments each provide tax credits, which can use to lower your taxes. Keep in mind that sometimes the provincial government does not offer the same tax credit as the federal government. So when the federal government offers certain type of tax credit, it may just be applicable to the tax rate imposed by the federal government, not the provincial one. Unlike tax deduction, tax credits are given to you using the lowest marginal tax rate rather than the highest. If you get a $10,000 tax credit as an example, and assuming that the tax credits are offered by both the federal and provincial government, the tax credits are usually calculated using the lowest marginal tax rate. And in our example, for a resident in Ontario, the tax saving would be $10,000 multiplied by 20.05%, which is the lowest combined tax rate between Ontario government and federal government. And for a tax credit that's equivalent to $10,000, this is a potential tax saving of $2,005. If you compare the tax saving from a $10,000 tax credit to a $10,000 tax deduction, you can see that tax saving from a $10,000 tax credit would only give you $2,005 tax saving, whereas a $10,000 tax deduction would give you a $4,341 tax saving for someone earning $150,000. It's a huge difference. Tax credit gives you tax savings calculated based on the lowest marginal tax rate. Tax deduction gives you tax savings calculated based on the highest marginal tax rate. So it's not difficult to conclude that majority of the time, tax deduction gives you the biggest tax saving, and you always want to get a tax deduction, not a tax credit if it's possible. Now, what are the common tax credits available? Some of the most commonly used tax credits available includes medical expenses, tuition tax credit, donation tax credit, disability tax credit, caregiver tax credit, digital news subscription tax credit. Interest on student loans are also examples of tax credit as well. There are some other tax credit, including working income tax benefit credit, as well as the property tax credit that is commonly known in Ontario for Ontario residents as well. You have to also keep in mind that not all tax credits are equal. It gets complicated. Some tax credits are refundable, while some tax credits are non-refundable. And as a matter of fact, most tax credits are non-refundable. As an example, the first-time home buyer tax credit is a non-refundable tax credit. It can be used to reduce your tax payable, but if you do not have a tax payable, then you're not entitled to a refund. Similarly, medical expenses, tuition, donation, disability, digital news subscription, interest on student loans are examples of non-refundable tax credits. They are all used to offset against the tax payable. If you have more non-refundable tax credit than your tax payable, then no refund would be issued. The excess tax credit is then unused. On the other hand, a refundable tax credit, such as the one called working income tax credit, are credits that will be paid to you whether or not you have paid taxes. Ontario Energy and Property Tax Credit is a commonly known refundable tax credit that's available to taxpayers that qualify as well. Now, it begs the question, do I always get a refund? Would you always get a refund if you have tax credit? Would you always get a refund if you have tax deduction? For tax deduction, you won't always get a refund. You will only get a refund if your tax payable after taking the tax deduction is greater than what you have paid to CLA. I had a couple of clients who are brand new real estate investors who quit their job, full-time job, and then do real estate full-time, and the investing is all they earn, and so and sometimes it takes a long time to renovate a new property. They spend a lot of money and effort on renovating their properties, and sometimes they're doing it for long-term rental purpose. So when the tax time comes, they are expecting a huge amount of tax refund. First of all, major renovation is rarely considered a tax deduction. It is considered a capitalized item, but that's a topic of another day. Secondly, even with legitimate tax deduction, assuming all the expenses are legitimate, if you have never paid taxes to begin with for that particular year, you will never get a refund even if you have a tax deduction. So since they were brand new investors, not earning income to begin with, there are no tax pay, and therefore there is no tax refund, even though you have a large amount of tax deduction. Now, the good news is that if you do have a substantial losses reported on your rental properties or a business loss as a result of claiming these deductions, if you have it as unused business deductions, and these business deductions that are unused, these business loss or rental loss that are unused, could then be applied in the future and carry forward to the future for you to offset against your future income tax expense. Now, as in terms of tax credit, as I mentioned before, some of the tax credits are refundable and some are non-refundable. So if you have non-refundable tax credits that are greater than the amount of tax that you would have to pay, unfortunately, the unused non-refundable tax credit would go to waste. Nothing will be carried forward. You won't get a refund. Now, for refundable tax credit, you would then be able to get a check from the government to help you with whatever you need. Now that we've covered the difference between tax credit and tax deductions, and you understand that we always want to have a tax deduction rather than a tax credit, almost always anyway. And even when we get the tax credit, we would prefer a refundable tax credit over non-refundable tax credit. You can get a better understanding from what the politicians are saying and what they are trying to offer you in general. If you find this video useful, make sure that you give us a thumbs up, and if you have not subscribed to our YouTube channel yet, make sure that you hit the little subscription button below so then you can stay on the latest tax tips. Until next time, thank you for watching.